Most traders think their job is to constantly take trades. They assume that being active, clicking buttons, opening positions, and always having something running in the market is what creates profit. I used to believe that myself. It feels intuitive, right? If trading is how you make money, then doing more of it should lead to bigger profits. More trades, more opportunities, more results. That's the beginner mindset. That's the mindset most traders never grow out of. But here's the truth that almost no one learns until they've donated far too much money to the market. Your real job as a trader is not to trade. Your job is to wait for trades worth taking and then execute them cleanly when they finally appear. That sounds completely backwards until you understand why the traders who succeed long term, the ones who last to 10, 20, 30 years, all follow this exact philosophy. Trading is one of the only professions in the world where doing less actually produces more. Let's start with the simplest layer that people ignore, the cost of trading. Every single time you open a position, before anything else happens, before the market moves, before your idea even has a chance to breathe, you start behind. That spread you pay, that commission, that exchange fee, that's all coming out of your pocket instantly. Most people never calculate what this truly means. They hear tight spreads, low commissions, and assume it doesn't matter. But it absolutely does. Imagine you're trading something as liquid as EURUSD. The spread might be 0.7 or else zero point 0.8 pips. Sounds tiny, almost irrelevant. But on a standard lot, that's $8 gone the moment you click buy or sell. You're already in the red before the chart draws a single candle. Multiply that by your weekly trade count. Maybe you take 20 trades. Now you're down $160 per week in spread alone. Keep that going for a month and it becomes $640. Keep it going for a year and you've burned through more than $7,500, not including slippage, commissions, overnight fees, or mistakes. And that's assuming you're trading something with some of the lowest costs in the entire trading industry. The more exotic you go, the wider the spreads. The less liquid the asset, the more you pay. Options traders pay spreads far wider than they realize. Futures traders pay exchange fees. Crypto traders pay maker and taker fees that add up quietly in the background. Costs are everywhere. Costs matter. And the more you trade, the more these costs eat you alive. Now, here's where things get interesting. Researchers who analyzed actual broker account data noticed something almost unbelievable. The people who traded the most performed the worst. Not just slightly worse, dramatically worse. The top chunk of traders by activity lost around 8% per year on average. The least active group lost just 2%. And the very small minority of accounts that were profitable, they traded way less than everyone else. Roughly 70% fewer trades than the average. This isn't theory. It's not motivational fluff. It's hard data from real accounts. The traders who clicked the button the most were punished. The traders who waited were rewarded. The pattern repeated across time frames, across instruments, across account sizes. Why does this happen? The answer has multiple layers: mathematical, psychological, and behavioral. And once you understand them, you'll never look at trading the same way again. Imagine your trading strategy actually has a real, measurable edge. Let's say that after factoring in your win rate and your risk-to-reward ratio, your true annual edge is around 3%. That's realistic for many strategies that have been tested and proven. A clean, small, stable edge. Now introduce costs. If your average round-trip cost, spreads, commissions, slippage, adds up to 0.5% per trade, and you take 200 trades in a year, you've applied a cumulative drag equal to 100%. This doesn't mean your account goes to zero, but it means the total weight of your costs over the year equals your entire account being dragged down by a full account's worth of friction. A 3% edge trying to survive under 100% drag? That math does not work in your favor. It suffocates the edge so badly that even a solid system becomes unprofitable. And here's the part people forget. Your edge isn't uniform. Some trades offer real advantage. Some are marginal. Some are straight up negative, even though they fit your rules on the surface. But costs hit all trades equally. So when you're taking low quality or medium quality trades just to stay active, you're multiplying your costs without multiplying your edge. Over time, your average expectancy collapses. Costs alone hurt performance. But that's not even the biggest reason overtrading destroys traders. There's a deeper factor, your brain. You've heard of decision fatigue. It's the same reason presidents wear the same outfit every day. It's the reason highly productive people eliminate unnecessary choices. The human brain isn't built to make 100 meaningful decisions in a row with equal clarity. In high-performance fields like medicine, aviation, and the military, researchers consistently find that repeated decision-making under pressure reduces accuracy and judgment, even among experts. Trading is the same. Every trade is a decision under uncertainty. Every decision drains mental energy. When you take your 15th trade of the week, you're not operating with the same clarity you had on your first trade. But here's the problem. Decision fatigue doesn't feel like tiredness. It feels like sudden confidence. It feels like you're finally seeing opportunities everywhere. You think you're sharp. You think the market is suddenly full of setups. But in reality, your brain has simply lowered its standards because it's tired of filtering noise. This is why traders who overtrade consistently take bad trades that they never would have touched when they were fresh. Their standards evaporate without them realizing it. Their clarity fades. They get sloppy, impulsive, hopeful. They stop analyzing and start reacting. The best traders on the planet protect their attention the same way they protect their capital. They scan the market frequently, but they only commit mental energy on select moments. They know their brain can only handle a limited number of high-stakes decisions before quality declines. Their secret isn't better analysis. It's better selectivity. Now let's go even deeper, to the part that completely rewires how you understand trading. The market doesn't follow your schedule. It does not care that you want 20 trades per week. It does not care that you feel productive when you're active. Some weeks, the market produces excellent, high-probability opportunities. Other weeks, it produces nothing worth touching. When you force yourself to trade frequently, you're not trading market conditions anymore. You're trading your own boredom. You're trading to feel active. You're trading to satisfy your brain's craving for action. It's like demanding that a company hire a new employee every week no matter what. Eventually, the quality drops. If you instead hire only when an amazing candidate appears, your team becomes exceptional over time. Trading works the same way. The more you force trades, the more garbage you let in. There's also a neurological reason trading is addictive. Your brain constantly makes predictions, comparing expectation to outcome. When reality surprises you, your brain generates a prediction error signal, and that releases dopamine. The more unpredictable the outcome, the stronger the dopamine. That's why gambling is addictive. It's why social media notifications feel rewarding. And it's why trading can become compulsive. Every trade carries uncertainty. Every trade offers potential dopamine. So the more you trade, the more you feed that cycle. This is why traders who overtrade aren't actually chasing profits. They're chasing dopamine. The fewer trades you take, the more this loop fades. You stop trading for excitement and start trading for quality. Your brain resets between decisions. You become more strategic, less emotional, more disciplined. Now, let's talk about what actually generates money in trading. Most beginners think it's about predicting direction. They think, if I can guess where price will go, I'll make money. Professionals don't think that way at all. They think in terms of edge, risk sizing, and, most importantly, trade selection. Imagine a strategy that wins 60% of the time with a reward-to-risk ratio of 1.5.1. On paper, that's profitable. But what happens when you apply this strategy recklessly? You take every trade that technically fits. Some are excellent, some are average, some are questionable. Suddenly, your edge gets diluted. Your A-plus setups might have a 75% win rate. Your mediocre ones might barely break even, but since you're treating them all equally, your average drops. But imagine you only take the A-plus setups, the ones with true edge. You might take 20 trades instead of 100. You may trade 80% less, but your win rate skyrockets, your expectancy jumps, your drawdowns shrink, and your stress levels fall dramatically. That's the math of selectivity. Warren Buffett once said that if people had a punch card allowing only 20 investments in their entire lifetime, they'd become incredibly wealthy because they'd stop taking mediocre opportunities. The same logic applies to trading. If you gave yourself a punch card with only 50 trades for the year, around one per week, your discipline would transform instantly. You would choose differently. You would wait longer. And your results would improve, not because your strategy changed, but because your selectivity changed. When you reduce your trading frequency, your risk management improves automatically. You're not jumping in impulsively. You're not trying to win back a loss immediately. You're not revenge trading. You have time between trades for your emotions to level out. Decisions become deliberate, not reactive. Now, consider drawdowns, the silent account killers. Every trader experiences losing periods, but overtrading makes drawdowns deeper and longer. When you trade too often, you compound losses through cost drag and emotional error. You take a small loss, then another, then try to win it back with trades you shouldn't take. Suddenly, a manageable drawdown becomes a hole you can't climb out of. A 10% loss requires an 11% gain to recover. A 20% loss needs 25%. A 50% loss requires 100%. The deeper the hole, the more stress, the more bad decisions. Meanwhile, the patient trader might take one trade per week. A loss sets them back 2% maybe. The next week, they take a clean, high-quality trade, recover, and keep going. Shallow drawdowns are survivable. Deep drawdowns destroy careers. People often point to day traders or scalpers as proof that high-frequency trading can work, but the reality is brutal. Most day traders lose money. The ones who succeed have advantages: specialized technology, direct market access, institutional-grade execution, or they profit from liquidity provision instead of direction. And even these successful scalpers are incredibly selective. They might look active, but they skip far more trades than they take. Even within day trading, the best performers take fewer trades than the average day trader. The same principle repeats: selectivity wins. A practical way to implement this is to categorize your trades like traffic lights. Green trades are the absolute best setups. Everything aligns. Yellow trades are decent, but not perfect. Red trades fit your rules on paper but feel off when you look deeper. Most struggling traders take all three categories. Successful traders take only the green ones. That alone can cut your trading frequency 80% while multiplying your effectiveness. There's another hidden cost of overtrading: opportunity cost. If your capital is tied up in 5 mediocre trades, you are blind to the exceptional trade forming right in front of you. Even if you see it, you might not have the margin to take it. Or worse, you pile into it with too much leverage while still holding those mediocre positions, and when one goes wrong, everything collapses. Being always in the market means you're never available for the highest quality opportunities. Patient traders keep cash and attention ready. They have dry powder, they have space to think, and when a truly exceptional setup appears, they strike with size and confidence. Trading is not about constant action. It's about precision. It's about waiting like a photographer for the perfect light, the perfect moment, the perfect alignment. One photograph can eclipse 1,000 forgettable snapshots. To make this philosophy real, try this. For the next 30 days, cut your trading frequency in half, but don't skip trades randomly. Rank your setups and only take the top half. Track everything: your win rate, your emotions, your costs, your average win, your average loss. You will almost certainly notice 3 things. Your accuracy improves, your stress decreases, and your profits grow, even though you're trading less. Because trading isn't about how often you pull the trigger. It's about what you're aiming at when you do. The market rewards patience, discipline, and selectivity. It punishes urgency, excitement, and frequency. Your job is not to trade constantly. Your job is to wait intelligently. The waiting is the job. The trade is just the moment you collect your paycheck for waiting. Trade less, see more, decide better, earn more. That's the real secret.